Okay, let's drill it down then to the Midcap earnings that we have lined up for you. Redington India has reported a mixed set of Q4 numbers in the fourth quarter. While the revenue growth stands at 26% on a year-on-year basis, margins have come under pressure. EBITDA margins currently stand at 2.5%, which compares with 2.7% in Q3 and compares with 2.8% same time last year. Rajiv Srivastava, Managing Director at Redington India, is now with us on the show now. The first question is actually on margins. 2.5% Q4 margins. What led to the pressure? And if you could provide a breakup in your Singapore-India business, CISA as you call it, and the rest of the world. Particularly in rest of the world, we've seen the margins contract. The reason for the margin contraction and to the outlook on margins going ahead.
Hi, good afternoon. And I think the margins are generally in line with what we saw as pressure on the market because the market was contracting in the last quarter and we bust the trend of growth. Our growth at 26% in revenue has been extremely robust. But obviously there was a pressure on inventory, there was a pressure on liquidation of stocks, which were built up across the industry as a whole. And those literally led to a reduction in the margin. Our EBITDA at 2.5 or 2.6% at 590 crores for Q4 FY23 are at the highest levels ever we've seen from a Q4 perspective. Our revenue is highest, I think, but the conversion from EBITDA to EBIT to PAT, obviously those are the ones which are under pressure because of the larger macroeconomic financial situations that the world is going through right now.
Srivastava, just one follow-up question then. So the issues that you faced, the inventory issue, the fact that you had to liquidate stocks, is this behind you all or is it going to continue even in Q1? And what can you guide on margins, sir? Can margins get back to the 3% level that you've seen sometime last year?
They will get better. The margins will surely get better between 2.6 to 2.8, 2.9%. And that would be our guidance to all the participants over here, that the margins will get back to a level. And that's how we would see the industry. The trend is behind us because there was a inventory which had got built up in the market, not only Redington, but across the industry as a whole. All the distributors were carrying a lot of inventory. The sudden drop in the offtake of largely the volume IT equipment, and you would see if I cut my business between volume IT and the value enterprise IT, you would find that the pressure was there on the volume IT. All the large vendors like Dell, Lenovo, HP, Acer, everyone had built inventory in the system, which had to be liquidated. And now, thankfully, in Q4, a lot of those corrections have been put in place. And we do feel that going forward in Q1, Q2 onwards, literally, for this financial year, we will see that the pressure in inventory will go down and the margins will start to trend a little better. The other thing which happened, which is important to understand, is the work from home and learn from home. Both of those reduced in Q4 and Q3 as well. And so the buying for the home devices reduced, clearly. The drop in the buying for home devices was faster than anybody anticipated. And that's how the inventory got built up. And I'm so thankful and so happy that all the vendors realize this. They have made inventory corrections so that the future, when the back to school starts to happen from the next month onwards, the festival season comes in Q3, you'll start to see a huge amount of uptake in the volume IT space. The commercial products, which is the enterprise products, continue to do extremely well. The network, servers, storage, services, cloud products, they did extremely well in Q4 and they continue to do very well because the digital transformation projects, as we are seeing them, there is no looking back on them. It's a one-way street. Companies that have committed to digital transformation projects, they continue. And we repivoted our model to make sure that we harness the potential.
So, Mr. Srivastava, I wanted to understand what is the percentage of revenues coming in from volume IT? You said that was something that started getting hurt, and now from Q2 you expect at least that inventory issue to get sorted. What percentage of revenues does it cater to, and is there a margin difference between the two segments?
Oh yes, of course. The percentage of revenue that comes from the volume IT place is about a third, about 35% thereabouts. There is a margin difference between volume IT and the enterprise IT. The enterprise IT runs at about 2 points higher than the volume IT.
And by volume IT, just for the benefit of our viewers, you mean the smartphone devices, the laptops, the tablets, right?
By volume IT, I mean tablets, laptops, desktops, and printers.
Okay.
The phones are a mobility segment, and you would have seen that globally there was a downturn in phones as well. The phones, every phone manufacturer across the world did have a bit of a loss of revenue and loss of volumes in Q4 and Q3. But one segment in the phone business, mobility business as we call it, is doing extremely well, which is between the mid to upper mid market price segment between 30,000 to 60,000. That segment is doing extremely well.
Okay. So just to understand the breakup then, you have enterprise IT, which is basically your cloud servers. You have volume IT, which is your laptop, printer, desktop, and computers. And you also have mobility, which is smartphone, right? What's the revenue breakup between the three? You told us about volume IT is 1/3.
Yeah, it's about typically a third split across all three. Yeah, you'd find that it's about we are well broad-based, and that really hedges us against any downturns on one single equipment. And so we are kind of quite broad-based. And then there's an element, which is the services. The cloud is very important for us now. We don't consider cloud as part of volume IT, value IT, or mobility. Cloud is a completely separate dimension because it's a subscription market. And that is the market which is growing the fastest in the industry. We grew 61% in cloud in Q4. So I think that's a very, very robust story for us.
So cloud has been doing well. What about the other two segments, the IT revenue and mobility revenue? While IT did see some dip, mobility was very strong. Can you give us an outlook on what kind of growth are you expecting here? And with the cash that you have in your books, are you looking at further diversification?
Look, our IT growth in Q4 was 16% and our mobility growth was 51%. And IT, when I say IT, was a combination of volume and value. And most of that growth came in the value space. Our value growth was about 40% and volume was literally flat, because you would see that across the world, when you take a look at what's happened to the PC and notebook and laptop industry across the world, there was a 30 points of dip year on year. But we stayed flat, or we stayed positive, about 4% positive growth. So we had a swing of almost about 35% with respect to the market. So we had a very, very strong growth in volume as well, though not as much as we would wanted it to be. But value was a 40% growth, and cloud was a 61, like I said, a 61% growth for us in that space. And I think we see the trend of growth in the markets we are placed in the geographies we're playing in, to continue. The geographies we are playing in, India, Middle East, South Asia, Africa, Turkey, and some of the CIS countries, those economies are largely consumption-driven. Those economies are investment-driven. Oil is a very strong factor in these markets, and that is doing so well. So I think we will see the trend of offtake in the IT industry continue to be very strong from our perspective, and we will continue to see a strong double-digit growth as we go forward.
Okay, double-digit growth and margins improving to 2.8, 2.9%, right? That's the guidance, Mr. Srivastava, that you're sharing with us.
Between 2.6 to 2.9.
2.6 for FY24. Thank you very much, Mr. Srivastava, for joining in. Look forward to chatting with you as the year progresses. We'll get into a break on that note and come back with more on the market. Stay tuned.